Coming hot off the heels of a week that's, of course, been dominated by the FOMC, you would be forgiven for thinking that the fireworks of 2025 are by and large done. That is not true. This week ahead is absolutely massive. We've got some belated data out of the US, and we've got rate decisions from the likes of the Bank of England and the Bank of Japan. So expect this to be the big final last hurrah before things quieten down towards the back end of the year. So first and foremost, let's look into the breakdown for the events. And generally, if I've got a busy week, I'll get rid of a few lines here and there of things that maybe aren't as important. This time around, that was not a possibility. Instead, we're having to put it onto two different slides. So here's Monday and Tuesday alone, kicking off with Chinese data, industrial production, retail sales, inflation data out of Canada. And then on Tuesday, the jobs report out of the UK, PMIs across the board, the ZEW economic sentiment out of Germany. And we've got the jobs report out of the US, payrolls for October and November. So that, of course, comes with the rest of it. Retail sales out of the US, and then trade data out of Japan. So, I mean, look, Tuesday alone looks super busy, right? And then coming into Wednesday, inflation data out of the UK, business climate from IFO in Germany, retail sales from the US. We don't have a timing attached to that. That might mean it's questionable whether it's actually going to come out or not. We'll have to look into that. Then Thursday, things really kick off again. Bank of England rate decision, ECB rate decision, US inflation on the CPI front. That comes off the back of core PCE data, of course. Inflation data out of Japan, and then things wrap up with that focus on Japan once again. A rate decision with markets expecting a hike to 75 basis points, 0.75. GfK consumer confidence, so another survey out of Germany, and then UK retail sales and existing home sales out of the US. It is, quite frankly, ridiculous, and it's going to keep everyone busy, because as soon as you're there talking about what happened the day before, there's going to be a whole raft of new things to consider for the day ahead. So let's look at the US first and foremost. Of course, we have got that jobs report release coming out alongside the inflation release. So you can see here in terms of non-farm payrolls, October and November data coming out. Of course, we also see unemployment rate data, average hourly earnings, the PMI numbers, the weekly ADPs, although that's probably going to become less important as we see the official data coming out. And then in terms of inflation, of course, core and headline CPI numbers, both at 3%. Where are they going to go? Well, first and foremost, let's look at that inflation picture. Of course, we're coming off the back of a FOMC meeting where we've already seen them cut and lay out a pathway where they're perhaps not going to do so for some time now. The projections were interesting within that, because there was a view that the core PCE inflation metric was going to drop down to 2.5 next year. So there is a view that inflation is going to ease off. And so the Federal Reserve do now have it within their projections that essentially Trump's tariffs are not inflationary, because we haven't necessarily seen a major pickup in terms of inflation. Is that going to be the truth of the matter? Certainly this CPI release is going to be important. Two CPI releases, October, November. You can see in actual fact, what's interesting about it is the last 2 months of CPI have actually started to see inflation take hold. You can see in the middle section of this chart that the two green bars on the right, the August and September ones. Core PCE didn't show it, but we have seen on the CPI numbers a rise in terms of inflation above that dotted line, which is just below the 0.2 mark, which would be consistent with getting back to that 2% target. So do we see a continuation? Do we see an exacerbation of the problem? Let's look in terms of expectations. Markets forecasting, according to Trading Economics, 0.2 on the monthly for core, 0.3 on the headline. So the headline expected to be a little bit higher than we need it to be, but neither are particularly sort of major problems in themselves. Of course, we don't necessarily know whether it's going to go over and above that. One of the key methods that Trump has been utilizing to keep inflation low has been to depress energy prices. And so that is likely to continue to play out as a potential driver of disinflation or keeping headline inflation low in particular. So by and large, we have, of course, seen inflation under control. We've started to see some warning signs over the past couple of months for the CPI number. What will be important here is, of course, do we see another move higher in terms of these 2 monthly metrics? And if we do, does that start to undermine the idea that inflation is under control? Is it a delayed response to some of Trump's measures? Remember, for many businesses, the tariffs were an opportunity to essentially stockpile, build up inventories, and hold off while trade deals were made. And at some point down the line, then all of a sudden you have to deal with the new tariff regime. So there has been a question mark on whether it's going to take some time to feed through. Arguably, looking at August and September, you could say that is happening now. So let's look ahead with these data points, try and understand exactly whether the paradigm shift is happening, albeit only in the CPI numbers, because the core PC figures thus far, we haven't seen it. In terms of the jobs report, of course, all eyes are going to be on the payrolls figures. We have been seeing the ADP numbers. They have been sort of fluctuating around a bit, but we haven't necessarily seen anything particularly impressive out of them. Markets, by and large, in the past have always said that the ADP numbers aren't really that relevant to the headline numbers. That may be true, but in actual fact, once you see the revised headline payroll figures, they actually have been not too bad in terms of the differential between the two. That being said, if you look at last time around, there has been a wide gap. Ultimately here, what we need to see is whether the jobs market is flashing red to the extent that the Federal Reserve need to be proactive in their approach and bring forward any easing. Market expectations, let's see if we've got anything on this slide. 55k for October, 10k for November. Notably, within the presser after the FOMC meeting, we did hear from Jay Powell, who essentially said that he thinks that the jobs data is perhaps worse than the numbers actually signal. So let's see. I mean, look, the revisions are always very interesting because by and large, they've all been downwards revisions. So yeah, again, if we see the narrative playing out once again, you need to see weakness in terms of the figures on the jobs front. If it all points towards the basis of needing additional action, then of course you're going to have the prospect of a sort of bringing forward in terms of rate cuts. Markets are now not pricing another rate cut until March or April. March at the moment is essentially a coin toss, marginally on the side of keeping rates steady. But whether it happens between March or April is probably going to come down to some of the data that we're going to see now and beyond. So this is where you're going to see the repricing. It's whether you see the rate cut in March or in April, in my mind, because it's very tight when it comes to March. And if we see data shifting in the direction that would allow it, say, weak inflation, weak jobs data, then it's likely that we would see that repricing coming into play. In terms of the markets to watch, I mean, there's lots of different things to look at. I wanted to look at the US dollar for one thing, but we'll do that in one of the other charts after this anyway. I wanted to look at the precious metal space. Of course, gold has been grabbing the headlines over the past year, but silver has really been on a rip. And we can see here that we've seen this sort of consolidation phase, the breakout, pullback, and we're breaking higher once again at the moment. Ultimately, silver has a number of different drivers, one of which will be the idea that the Federal Reserve are going to have to be relatively proactive going forward. The fact that they have enacted, albeit a small but notable balance sheet expansion with that 40 billion move from the Federal Reserve, is a signal that if they're willing to do that now, what are they going to do if the economy starts to turn sour and they actually need to step in? Could we see QE down the line? That kind of thing, certainly very positive for the likes of gold and silver. So keep an eye out for this. We've got trendline support coming into play at the moment. I think, following this breakout from consolidation, I'm expecting to see retracements being bought up once again. So it's a case of looking out for swing low support levels, the most recent being 627. And as long as we don't break through that, then pullbacks are there as opportunities for bulls. I am bullish, but you've got to look out for the data as well. And if we see weakness in terms of inflation, weakness in terms of jobs data, I think that provides the basis for further upside to come for silver prices. Next up, let's look at the UK. A rate decision from the Bank of England that by and large markets are geared up towards a rate cut. Certainly would be welcome because they've been relatively patient in their approach thus far, in part because of the elevated inflation rates has been the highest in the G7 for some time now. But perhaps that's going to come down. Now, in terms of the economy, do we see grounds for them to take a more proactive approach because of the weakness in the jobs market like we're seeing in the US? Well, unemployment expected to rise, average hourly earnings expected to drop off, so inflation pressures easing, the employment change, a sharp decline of 60K expected. So the jobs report is expected to show a signal to the Bank of England that they need to be proactive. In terms of the inflation rate, look at that headline inflation number, 3.6 down to 3.4 and 3.3 on the core down from 3.4. So disinflation expected to come into play. And bear in mind that the recent budget certainly has a nod towards what happened in the past and the fact that actually the government stoked inflation in their previous budget. This time, they enacted policies that have been deemed to be disinflationary in nature, in particular in 2026, expected to trim roughly 50 basis points off the headline CPI number for next year. So that provides, for an inflation expectations perspective, the view that the Bank of England can be more proactive, which brings the possibility of downside for the pound. In terms of the charts, here's the UK inflation starting to come down a bit. But what we can see here is that the big problem is that April reading. If you look at that middle section here, by and large, since April, inflation has been relatively under control. You could see that the October numbers are a little bit problematic at 0.4 and 0.3 on the core. But nonetheless, inflation has by and large been under control. And if you look at the 6-month annualized reading at the bottom, you can see that decline. It's rolling over as we now see that sort of April figure dropping out of that equation. So the pathway over the past half a year is consistent with a decline down to 2.5, 2.4 kind of region. If we see additional weakness in terms of inflation this time around, then it's really going to continue that narrative that you don't have to wait until headline inflation drops to 2% or 2.5% for you to act. The Bank of England are expected to cut rates, despite the fact that inflation is in the mid threes. And part of the reason for that is the weakness of the economy. But part of it is the fact that if you look at the trajectory of inflation and you move beyond that February, March, April period, it's been under control. And so that really means that if we continue on a pathway we have seen over the past 6 months, then we will be moving much closer to that 2% target than we are at the moment, which looks like we're some way away from it. In terms of the jobs market, you can see here a rise in terms of unemployment, a rise in terms of the claimant count. There's an expectation we're going to see additional concerns growing within this current jobs report. It all points towards the Bank of England needing to do more. So again, that narrative around the action of the BoE going forward will be key here. As you can see, 90% chance currently being priced, according to Refinitiv, of a rate cut on this occasion. And therefore, with markets by and large counting it as a given that we are going to see that rate cut, keep an eye out for some of the commentary that comes alongside this report to see whether we're expecting to see rate cuts in the next meeting in February, or is it going to be March, which is currently a near enough 50-50, a little bit more, 55% chance that we see rates steady, or is it April? Certainly, the fact of the matter is that we have been seeing a more patient approach when it comes to the likes of the Bank of England and some of the other central banks, most notably the likes of the Bank of Canada, the ECB, the SNB. They have been running away with it when it comes to rate cuts. They've now stopped their process. The Bank of England is in the position where they can continue their process. And now more recently, we have dropped down through trendline support here for euro sterling. In actual fact, it's not really much for trendline support because we've only got 2 touches, but the trend here is clearly defined. You can see here, which benefits the likes of the euro against the pound, as we see the rate differentials coming into play and shifting more in favor of euro strength now that they've essentially underlined the end of their easing process. And that's going to be in focus once again with the ECB this week, but also the likes of the Bank of England really starting to ramp up their action. And you can see here this pullback looks to me like an opportunity. The 61.8 may have not been respected too well, but you can see essentially it's this zone, this deep fib zone that price actions come into, now starting to turn higher. Do we see a breakup through this near-term swing high? That's going to be the key thing. 0.88. If we break through that level, then it looks like this pullback phase is over and that the bulls are going to be back in charge once again for euro sterling. In particular, if we see that rate cut from the Bank of England and an outlining of a ability and a willingness to continue to act going forward, that's going to be really important as we potentially see a continuation of what has been a lovely trend here for euro sterling. And finally, we have the likes of the Bank of Japan coming up on, there we go, on Friday. It depends where you are in the world because it will be in the early morning UK time. But that comes alongside PMI numbers coming out on Tuesday, inflation data coming out on Thursday. Inflation elevated by nature, roughly around that 3% mark. So that points towards a possible need to take their foot off the gas, the possible need to normalize interest rates. Of course, they've been so low for so long that, as you can see here, markets are predicting a move from 0.5 up to 0.75. It's still very low compared to other regions, but of course you have the question marks about interest rate differentials and how they shift when you're seeing, say, the Federal Reserve cutting rates and the BoJ raising rates. The problem here is that you see the question marks around rising yields in Japan and the possibility of flows coming out of other parts of the world that we have seen essentially benefiting from the carry trade and the kind of disruption that could cause. In terms of inflation, you can see here coming down a little bit, but you've seen a bit of a troublesome October reading. So, you know, there is a question mark on whether they need to act over the near term. And it appears to be the case that with the government coming in with fiscal expansion policies, that we're going to see a normalization by seeing the BoJ moving in the opposite direction, raising interest rates. You can see here in terms of market expectations, 76% priced for a 25 basis point cut, this hike this time around. There's not much priced over the near term after that, but then you see the possibility of another hike in the sort of second half of next year, essentially. Now, one thing that I thought I'd pull up here is a number of different sort of correlated markets to highlight how this could potentially impact different indices, different FX. So as you can see here, the relative yields between Japan and the US on the rise. That means that because we're expecting to see rate cuts from the US and because we're expecting to see the Japanese raising rates, and because we've essentially seen the Japanese do away with their yield curve control, and we've seen yields continuously moving higher, that has caused a number of different things. We have been seeing outperformance for the Nikkei 225 against the likes of the Dow for some time now, with the view that we're going to see expansionary fiscal policy coming into play, but also the notion that if we see higher yields, funds flow back into Japan. That's great and everything, but it does come to a point where you see the possibility of stresses within the financial system because of this. And also, if we see elevated yields to a certain degree, then some of the flows come out of Japanese stocks because essentially they've got a risk-free alternative to make money if you have such elevated yields. So certainly yields rising appear to benefit the Nikkei only to a certain extent. And you can see here the Nikkei divided by the Dow essentially has been tailing off over recent months. Dollar yen, though, has been pushing higher once again. So we've been seeing the two moving in tandem. Now, in terms of current price action. Let's see exactly how dollar yen has been playing out, because essentially you've been seeing this significant pullback coming into play from a, let's see, from a weekly time frame. You can see, let's just get this on. There we go. So from a weekly time frame, you can see the long-term trend has been a bullish one, but we've been seeing these wide swings, and often when you get towards this sort of 155 area, like, you start to fear potential intervention from the Chinese to try and drive down dollar yen once again. More recently, what have we seen? We've seen a rally up into the sort of 158 area, a pullback, a short-term rally, and now pull back into the 76.4 fib. So do we see this sort of trendline support coming into play with the bulls returning once again, or are we starting to see this roll over with the idea that the BoJ are about to hike rates, potentially providing some strength for the Japanese yen? Certainly the dollar index has been showing some weakness after that FOMC meeting. So there's question marks there as well. But certainly if we see a breakdown through this 76.4 fib, which is around your 155 mark, and in particular 154.34, then it does tell a story of a market that could potentially start to top out and start to show signs of fading the gains that we've been seeing over much of the past 6 months, but in particular over the course of October into November. So a massive week ahead. I hope this has been useful for all of you. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.